Thanks for hanging out with us, traders and investors. You're listening to Benzinga's Pre-Market Prep. I'm Brianna here. I'm Brianna Valesky here with Joel Elkann, and we have David Kudla on the line. He's the CEO and Chief Investment Strategist at Mainstay Capital Management. David, how are you doing this morning? Thanks so much for joining us.
Doing great. Good morning.
Wonderful. Well, you're going to be a little closer to our area this week, later in Detroit, actually, at the Engage conference at Cobo Hall. Can you tell us a little bit more about that?
Sure. The Engage conference is the largest student investment conference in the world. It's going to be right here in Detroit, Michigan, at Cobo Center. We'll have university students coming from universities across the country, from Canada, even from Europe. Even have some high school students there, and we have got a lot of great guests through the day for panel discussions, a lot of interaction, and we have CNBC coming in both days. They'll be reporting live from the conference.
This seems like a fantastic opportunity for students, for people in the finance industry. Is this the first year that we're holding it in Detroit?
This is the first year in Detroit. I've worked on similar conferences like this in the past, one the past couple of years, and I want to do a conference like this in Detroit.
Absolutely. Well, if anybody is in or around or even close to the Detroit area, they definitely need to be at this conference later this week, guys. I'm going to drop a little bit more information into the chat room so you can learn as much as possible about this opportunity. David, I'd like to switch a little bit and talk about you. What made you decide to found Mainstay Capital in 2000?
Well, I was working in the auto industry, actually as an engineer, and had a passion for investing. And as I became more invested, made a career transition and founded Mainstay Capital Management as an independent registered investment advisor. And the rest is history. We're managing $2 billion now.
So you're also the chief market strategist. Can you give us your general market overview right now?
Sure. As far as the U.S. market, we believe we're still in a long-term secular bull market. We're concerned in the near term because we've had stocks come a long way, actually a bull market over the past 6 years. Valuations above fair value for U.S. stocks. We've gone 43 months without a correction. We have an imminent Fed rate hike, and so we're cautious on the U.S. market, and we're looking more overseas in 2015.
Eminent rate hike. So what are you looking for? The meeting at the last meeting they came out, they took out the word patient, they put in deliberate. What's your time horizon on that?
Well, as Janet Yellen said, they've taken out the word patient, but that doesn't mean they're impatient. And you've got some varying opinions within the Federal Reserve itself, with the Federal Reserve presidents and governors on where they're going with rates. You've got dissenters that are saying that they should wait till next year for a Fed rate hike. You have Bullard, who gave a speech in Europe just the past day, calling for this summer. You have Dennis Lockhart, who will be actually appearing at Engage Live in Detroit on Thursday morning this week. He's still looking for a summer to fall. So, they were very transparent with the ending of quantitative easing. This time last year, they told us they would end quantitative easing by the end of the year, probably in October, and they did that in a very deliberate fashion. Now, there's a lot more question about when we'll see that first rate hike. We're still looking for that mid to late year for the first Fed rate hike this year, and probably not a continued rise after that. We think they're being they're being more deliberate, or being more deliberately being less transparent with when that Fed rate hike will come and subsequent rate hikes than they were with the tapering of QE.
With, what are the two criteria? Number one is obviously the strength of the economy. Are you seeing signs that the economy is, anything more than tepid growth? And the other thing that interest rates are tied to are inflation, and there's nary a sign of inflation here. So what's your take on those two things?
Well, that's been the frustrating thing about this recovery, and it's been similar to past recoveries, but but after the Great Recession, we've had an anemic recovery. We've had anemic growth, and that's what's been frustrating. We've never really reached that lift-off velocity that we want to see. We had one good quarter of CPI, or one good quarter of GDP at 5%. But other than that, we've been running around 2 to 2.5%. So we've never seen that really robust growth. We're looking at 2.5 to 3% for 2015 in GDP growth. Probably what's encouraging is the CPI data that came out today. We saw year-over-year core CPI increasing 1.6 to 1.7%. We saw the month-to-month first increase in CPI since October, with core and both headline up 0.2%. So we are seeing indications, again, 1 month's data, that inflation is on the rise. So that's half the story. With what they're looking for in economic data, what they're looking for in inflation. Inflation has been held artificially low for several months now because of the decline in oil prices. We've been seeing lower numbers, but even backing out, and looking at core, when we back off food and energy, we had a stronger number here just this morning. So if we continue to see that, it may yet be midsummer we see that first Fed rate hike.
When you talk about overseas investments, do you mean Europe specifically, or are there other countries that you're looking at?
So as far as overseas, we like developed over emerging market, and specifically, yes, we like Europe and Japan. And the key thing there in both of those markets is to be investing dollar hedged. So in Europe, our vehicle of choice is HEDJ, which is Wisdom Tree Europe hedged, and basically hedging out currency risk. We've had a dollar to strengthen significantly over the past year. So we want to back that out so it doesn't have an adverse impact on our returns. HEDJ, very strong this year since the beginning of the year. DXJ for a couple of years has been a good trade. That's the Japan Wisdom Tree product. That's the Japan ETF hedged for the dollar. Both of those doing very well this year. A good way to play both of those markets. And we saw some good data from Europe this morning too. Europe PMI at 54.1 versus 53.3 last month. Fastest growth in 4 years. Europe is undervalued right now compared to the U.S. We're seeing an improvement there, even though they have some long-term structural issues still to work through. But the most important factor looking at both Europe and Japan is quantitative easing. And this is what we've been saying about quantitative easing for 4 years. We continue to say it because we think the jury's still out on this. We don't know, or there's going to be a debate for a long time among economists and others of what quantitative easing, printing money, means for the real economy. But one thing we know it does, and it did it here in the U.S., is it raises asset prices, one of those assets being stocks. So we've seen that in Japan. In Japan, in the local currency in 2013, and the Nikkei 225 up 57% in 2013. We're seeing Europe doing well this year for the same reason. And these are massive quantitative easing programs that are going to be a floor for stock prices in these markets for a long time to come. In Japan, they have underway now and will probably increase, Kuroda, the governor there, will probably increase, even what they're doing now. It is the largest QE program relative to the size of that economy in the history of the world, larger than ours. In Germany, in Europe, a little bit different. Largest QE program relative to the bonds that are available. The question is, will they be able to find enough bonds to buy for the more than 1 trillion euro that they're going to be injecting into the system, buying assets over the next year and a half? And we're already seeing the impact of that. We're seeing bond yields go negative there, which brings us back to the U.S. and the reason why we think yields stay lower here for a while.
Love to get your perspective on the auto industry. You worked in the auto industry. You left before things got, on the rough side. You had the bailout. Seems like such a long time ago. What just overall? I mean, without commenting on the individual stocks, GM making multi-year highs, Ford making a run up here as well. So goes the auto sector. They used to say, so goes the economy. What's your take on the auto sector?
Well, we've seen from the days of the financial crisis, and obviously the complicated environment, or the environment we had for the domestic automakers, just a terrific rebound from there. We're back up to pre-crisis levels in our volumes, up around 17 million units that we expect, maybe even 17 million plus this year. In units for annual sales. Ford is particularly interesting. They invested a lot in the company last year. The F-150 is selling like hotcakes. They invested in infrastructure, in some efficiency across vehicle platforms, and that's going to pay dividends this year. We're looking at Ford potentially climbing above 18 yet this year. General Motors, likewise, great story, great rebound over the past several years, and they're troubled by the recall. And it looks like they're troubled by the recalls they've had, and it looks like there's a new dimension to that as they're coming back in to investigate more. But that was a real had adverse impacts last year for the company in terms of the set aside for legal expenses and so forth, and fines. But looking forward for both of these companies, we're not going to grow probably a lot from here in annual volumes in the U.S. But if you look at what both these companies are doing in China, it is amazing. GM sells more cars in China now than they do in the United States. Ford a little bit more behind the curve. GM there first, but Ford has just incredible expansion plans in China, in dealerships, plants that they're building. China's a growing market, and both of these companies are there and are making great progress.
Okay, one more thing. We've talked interest rates. We've talked the dollar a little bit. We've talked the economy. Another big factor has been the oil. In the oil sector, boy, these stocks have gotten beat up here. You get Barron's coming out every couple weeks. Oil's going to $20, and you don't know how true that scenario is. On the other hand, it just can't get back over 50. What's your take on oil, short term and long term? And do you look as the oil sector, the way some of these integrated oils have been beat up, is with a nice dividend, perhaps a potential good long term investment?
Well, it's interesting. I've done several interviews when we've had questions about oil. In my statement going back to October, or when asking about the energy sector I don't know where the floor in oil prices is. And there are a lot of people been coming into the energy sector thinking they're buying those stocks cheap or buying oil. And we've seen it continue to fall near its low, again, just in the past week, around 43 and change, I think 42 and change in intraday trading on West Texas Intermediate crude. I think that low oil prices are here to stay for a while. And I think the key thing to remember here, everything is relative. If you look at a long-term inflation-adjusted average price for oil, we're right around that. But what are we comparing it to? We're comparing it to oil at 108 in July of last year. But what's going on is we have basically the world is awash in oil right now. The Saudis are not cutting production. They want to maintain their market share. You have everybody pumping oil that needs to pump oil because they need cash flow, whether that's countries that need it to support their overall economy, or whether it's the horizontal drillers or frackers in the U.S. that need to raise cash so they don't go out of business. But the bottom line is, people that are calling for $70 oil soon, I just don't think we'll see it. I had someone just stop by this morning, someone from an oil company this morning. They're running out of places to store oil. And he asked if he could store oil in my swimming pool in the backyard. And that's how bad it's getting. I'm kidding. But they have, the world is awash in oil right now, and that's going to keep oil prices long for quite a long time.
That's a great point, Dave. We've just got a minute or two left with you, so I want to finish again talking about the Engage conference later this week. I mean, you guys have put together an impressive lineup. You got Pete Najarian, Stephanie Link from TIA Kraft, Jeffrey Kleintop from Charles Schwab, having panels and roundtables, and even CNBC's Fast Money halftime report. What are you most excited for out of this conference?
I'm most excited to see the students. The neat thing about this conference is this is where theory meets practice for the students. They've learned a lot about finance, about economics, about business in the classroom, and here this is where they see the professionals. They get to network with them, talk to students from other schools, talk about their career, talk about what they want to do. We have a stock pitch competition that's going to be a lot of fun that we do live on Friday. It's single elimination like an NCAA tournament. We have our portfolio competition, best risk-adjusted returns from last year. And it's just a lot of fun, and the students really enjoy it. It's a very, very rewarding experience and fun experience for everyone.
It sounds like it's going to be a lot of fun, very unique experience as well. All right, we've had David Kudla on the line. He's the CEO and Chief Investment Strategist at Mainstay Capital Management, talking market overview, global markets, economics, oil, interest rates. Dave, thanks so much for joining us this morning. We really appreciate it.
Thank you.